Hi, and thanks for stopping by. My name's Larry Weinstein, and I'm both a CPA and the founder of SolveMyTaxProblems.com. And today I wanted to spend a few minutes sharing with you how the IRS treats a substitute for return. Basically, a substitute for return is a tax return that the IRS has already prepared. They have taken information that they had available to them as far as your income, and they've prepared a tax return for you, also known as making an assessment. Now, how does the IRS treat this substitute for return? How does the IRS treat making an assessment? Well, simply stated, the IRS treats this assessment that they've made on your behalf, because the taxpayer never filed the tax return in the first place. The IRS takes this substitute for return that generated the SFR, and they treat the SFR, the substitute for return, as if the taxpayer had filed the tax return themselves. They take the tax liability that they've generated by making an assessment, and they treat it as if the taxpayer had filed the tax return themselves, and the tax is due to a taxpayer-prepared return. Accordingly, they treat it as a valid debt on the books of the IRS, as if you prepared the return yourself. And accordingly, if it's a valid debt, then it's fair game to go after you to try to collect the tax, to go after the taxpayer to try to collect the tax, and accordingly go using the IRS collection process. Anyway, that's it for today's video. How does the IRS treat substitute for returns and the tax assessed? Thanks for stopping by, and we'll talk to you real soon.